Hey everyone, and welcome to today's Explainer. We're jumping right in today because we are unpacking a high-stakes, behind-the-scenes operation that literally every successful business has to master: corporate cash management. It's this ultimate strategic tug of war between keeping a business entirely safe and maximizing its profitability. So let's explore exactly how the pros manage their most liquid asset. Okay, let's dive into this, because I want to challenge a super common assumption right out of the gate. You'd think having a ton of cash is always a good thing, right? Well, not exactly. While hoarding cash definitely feels secure, in corporate finance, excessive idle cash is actually a massive liability. It actively impairs your profitability. Sure, having inadequate cash stops production dead in its tracks, but having too much? That means you're leaving serious money on the table. Finding that perfect equilibrium is exactly what this explainer is all about. Here's our roadmap for today. First, we'll look at the cash dilemma. Second, why hold cash? Third, the balancing act. And finally, finding the sweet spot. Let's get to it. All right, part one, the cash dilemma. We really need to understand the common denominator here. So when we say cash in working capital management, we're actually taking a pretty broad view. We aren't just talking about stacks of physical currency or what's sitting in a checking account. We're also talking about near cash assets, things like marketable securities and time deposits. Why? Because you can readily convert them into cash at basically a moment's notice. The source text actually makes a brilliant point about this. Cash is literally the most important, yet somehow the most unproductive of all current assets. I mean, think about it. Idle cash earns absolutely nothing. So any excess cash a company has is almost always invested in those short-term, near-cash marketable securities. That way, it actually contributes to profitability while still remaining accessible. Let's move to part two and see how this builds. Why exactly do companies hold cash? We've got four main motives. If idle cash is really that unproductive, why hold on to it at all? Well, the source material points us to four highly practical, everyday motives: the transactions motive, the precautionary motive, the speculative motive, and the compensation motive. Let's break these down one by one. First up is the transactions motive. Now, in a perfect world, a business would receive money from its customers at the exact same millisecond it needs to pay its own bills. But, in reality, cash inflows and outflows almost never perfectly sync up. You've got to pay wages, taxes, interest, or buy raw materials today, but your biggest client, they aren't paying their invoice until next week. So firms hold a transaction cash balance simply to meet those expected routine obligations when the timing just doesn't match up. Next, we have the precautionary motive. Think of this as your classic emergency fund. Business is just incredibly unpredictable. You might face sudden strikes, totally unexpected delays in collecting payments, or massive out-of-nowhere spikes in the cost of raw materials. So a precautionary cash balance acts as an absolutely vital financial safety cushion. Now, exactly how big this cushion needs to be depends on two things: how unpredictable your specific cash flows are and your ability to borrow short-term. If a firm can easily grab a short-term loan on a moment's notice, they really don't need to keep as much of this precautionary cash lying around. The third motive is the speculative motive. This one is a bit less common, but man, is it highly strategic. Sometimes firms keep cash ready specifically to exploit sudden, profitable opportunities that just pop up in the market. Imagine a scenario where the price of raw materials suddenly takes a nosedive. If you've got cash on hand, you can immediately buy in bulk and lock in massive cost savings. Or perhaps interest rates are expected to decline, so the firm holds cash just waiting for that exact right moment to buy securities. It's really all about being ready to jump on sudden market advantages. Finally, we have the compensation motive. Now, what's really interesting about this one is how it brings banking institutions into the equation. Banks provide all these critical services: clearing checks, transferring funds, providing credit lines, but instead of charging direct fees for everything, firms often just maintain a compensating balance. The bank can use that minimum balance sitting in the account to earn a return for itself, which indirectly compensates them for the services they provide to the firm. It's a really fascinating, often overlooked reason why funds get tied up. All right, part three, the balancing act. This is the classic showdown between liquidity and profitability. And this brilliantly illustrates the core Goldilocks tension of our whole explainer. It's the ultimate tug of war that financial managers face every single day. On one side, a high cash position guarantees solvency. It builds amazing relations with your creditors, lets you snap up early payment discounts, and protects you from unexpected shocks. But remember, high cash impairs profitability. On the flip side, A low cash position means your funds are heavily invested. They're out there earning interest and maximizing profit. However, that introduces the very real danger of short costs. These are the nasty penalties of running out of cash, like taking out super expensive emergency loans, missing trade discounts, or literally damaging your credit rating. The entire goal is to perfectly reconcile these two conflicting objectives. So, how do we solve this? Let's move to part 4, finding the sweet spot using mathematical models. So, how do managers actually nail down that perfect, just right balance? Well, they use mathematical models to calculate the optimum level. One really classic approach is the economic order quantity, or EOQ model. It was actually adapted from inventory management, and it views cash exactly like any other physical inventory in a warehouse. So the crucial point is that it determines your optimal cash balance by finding the exact point where two specific costs are minimized together. The carrying cost, which is the interest you are losing by holding idle cash, and the ordering cost, which is the fixed cost of actually going to the market to convert securities into cash. The EOQ formula uses just a few simple variables to output Q, which is your optimum level of cash inventory. It takes A, the total cash demand you have for a period, multiplies it by O, the fixed cost of securing that cash, divides that whole thing by C, the interest rate you could have earned, and then finds the square root. It is a brilliant mathematical balancing scale, but it has one major limitation. It assumes your demand for cash is totally constant and perfectly predictable. And as we all know, in the real business world, cash flows are rarely that cooperative. Because real life is incredibly messy, economists Miller and Orr developed the stochastic model. This is a highly sophisticated, super practical solution designed specifically for businesses where cash balances fluctuate randomly and unpredictably. It totally accepts that cash flows move up and down in irregular ways day by day. So instead of trying to hit one rigid fixed number, it uses dynamic control limits. Honestly, the best way to understand the Miller-Orr model is to think about the air conditioning thermostat in your house. The model sets an upper limit and a lower limit for your cash. If your cash balance randomly drifts up and hits that upper limit ceiling, the model automatically triggers. It tells the manager, hey, transfer that excess cash into investments right now to earn interest. But if the cash drains out and hits the lower limit floor, it triggers again, telling the manager to liquidate investments back into cash. In both scenarios, it automatically brings the business right back to its target cash balance. It keeps the financial temperature perfectly optimized, so to speak. And to find that exact target cash balance, that absolute sweet spot the thermostat always returns to, the Miller-Orr model relies on some very real-world variables. It looks at the fixed costs of making a transaction, the exact interest you could be earning per day on your marketable securities, and crucially, the variance of your daily net cash flows. By mathematically factoring in just how volatile and unpredictable your daily business actually is, it calculates the absolute best, most profitable safe zone for your funds. By really understanding these mathematical models and everyday motives, corporate cash management completely transforms from this boring, mundane accounting task into a highly dynamic, profit-generating engine. Which leaves us with a final question to chew on today. And this applies whether you're looking at a massive multinational corporation or literally just your own personal finances. Is your cash acting as a stagnant safety net, just sitting there doing absolutely nothing? Or is it operating like a finely tuned thermostat, actively maximizing your financial potential? Thanks so much for joining me to explore this incredible topic today. Keep learning, keep balancing, and I'll see you in the next explainer.